Good evening, everyone. Welcome to our Homebuyer Workshop in partnership with the UVA alumni. My name is Jason Maida. Great to be with all of you this evening. Thanks for taking time out of your busy schedules this week on a Wednesday evening just to learn a little bit more about our Home Buying 101 class. So really excited to be able to present this to you. This is a 1 hour class that's very interactive. So as we go through tonight's list of content, we would encourage you to ask questions of us. We'd love to be able to answer some of those questions on air for you. You can use the chat feature or Q&A within Zoom. I'll be kind of monitoring both windows and be able to kind of take your questions on air. We'll also carve out a little bit of time at the latter part of tonight's class to answer any questions that you might have. This is a class that we provide 4 times a year. So it's offered once a quarter through the UVA Alumni Association. And we've been doing this for several years in partnership with them. And it's just really a joy to be able to present this content into our communities all across the country. I got a chance to talk with one of your fellow alum here just about an hour ago. She was looking at buying a house out in North Carolina. So we were kind of restructuring her financing to help her in her journey towards home ownership. And you're going to learn a little bit about those elements that go into achieving that goal of home ownership. So really excited to be able to bring this information to you. Again, my name is Jason, so I'm going to be your presenter this evening. I also get a chance to work with you one-on-one as we kind of take those next steps in home ownership. So our relationships with our clients in the community usually start with a class like this just to help kind of coach you up on what home ownership looks like and provide you all the really important elements to home ownership. And then when you're ready to take those next steps, we'll hopefully be here as a partner for you to help you on that journey towards getting your home. Here's our talking points for this evening. We'll talk a little bit about the housing market, also what's happening with interest rates and kind of the volatility that we see in today's market. We'll also look at, does buying really make sense for me? So if we were to look at our scenario today of renting and kind of where I'm at today with the payments I'm making, how does that stack up against maybe buying some a home, right? And what are the benefits really going to be for me in home ownership? Can I really make the math work, essentially? We'll also talk a little bit about credit, how we can build our credit up if we need to, or maybe identify some areas of opportunity for us in our credit score. We'll outline some different loan programs that are available to you. A lot of programs you've probably already heard about before, but I'll kind of put the pieces to the puzzle together for you. Also talk about how do we save for home ownership. That tends to be a bit of a challenge for most clients. We'll also spend time looking at first-time buyer programs. So depending on where you're maybe thinking about buying, there are various agencies that are there to help support you. And we partner with many of those all across the country. And then we'll go through the buying process. So after you leave tonight's class, if you're thinking about home ownership, whether it's a this year goal or maybe a goal over the next 2 or 3 years, we want to kind of tell you how do we get there from classwork to actually getting to the finish line of home ownership. And I'll talk to kind of how we go through our free consultation and how you can get started with that process. All right. So thank you so much again for joining class tonight. We are recording tonight's class as well. So we had a lot of folks sign up for our session, but we will also have this up on our YouTube channel. So we appreciate you being part of the live class. And then we'll also share back with you all of our slides from this evening. All right, well, let's go ahead and launch into class. And I think the first place to start with our conversation is to talk about, does buying really make sense for me? And some of us are in a really good financial position and we're ready to go. Others, maybe we need to work towards that goal. But I think as we're considering home ownership as that goal, we want to think about, why would I even want to buy a home, right? Well, couple different things that come to mind for me is, one is it's going to create opportunities to maybe control our housing expense on a month in, month out basis. Many of us that are renting today, when we decide to renew our lease, the landlord's probably going to kick up the amount of rent. I can't tell you how many times a day I'm talking to clients. They're like, hey, my landlord just increased my rent $100 or $200. And those are impactful changes to us in our overall housing expense. So home ownership can control that for you. Also, many of our clients that are deciding to buy in today's market, let's face it, interest rates are a bit higher today, and we'll talk more about that tonight, but there will be opportunities to refinance a home later down the road when rates hopefully dive a little bit lower. And then, this is an asset. So it's a big deal when we purchase a home. This asset can work for us as we pay down our mortgage that we have, as the home hopefully goes up in value. The difference in those two numbers is called home equity. And for many of us, that's our number one asset that we have. So for us that are homeowners today, it's usually that as a big asset is our home, but also maybe retirement. So home ownership can really work for us. And it does create this kind of transformational experience for many borrowers that decide to take on home ownership. Has the opportunity to create generational wealth for families. Be able to buy that house for $300,000, see your home go up in value, every year or maybe over the span of 4 or 5 years, and then be able to take that equity that you've now earned in that home and use it for the next buying opportunity. That's the kind of the transformational steps that happen when you're a homeowner. And there can be some potential tax benefits that come along with owning a home, potential tax benefits when it comes to deductibility of interest, as well as some of maybe energy efficient upgrades that I make to my home. Those can plug into other tax benefits as well too. So I always encourage clients, like when you think about home ownership, it's so much bigger than just having a rent payment that looks similar to, or having a mortgage payment looks similar to a rent payment, because of all of those great things that come out of the benefits of home ownership. Well, I want to help illustrate that point with one of our calculators. And again, in case you missed it, because I know we have some folks joining a little bit late, we're on all time zones. So obviously we have, some of us are still at work, some of us are maybe just getting home from work or getting ready to sit down for dinner. So, we will have this class recorded for you, but a lot of the materials that I'll share back with you will include things like this rent versus buying calculator. This is a great way of just helping you better understand about what could homeownership be for me. So I'm going to walk you guys through like a pre-filled scenario here, just so you can kind of understand a little bit more how that looks. And so we'll take you through this calculator now. And by the way, on our website, we have some other calculators that I would encourage you to check out. Things like our affordability calculator, refinancing, which is going to be down the road for us once we become homeowners. And then of course, just a basic payment calculation so we can figure out if a home meets our budget or not. But let's look at our scenario here. We're going to assume that this particular scenario has a buying price of $450,000 for a home. As first-time buyers, the minimum down payment is 3% on a conventional home loan, which basically means we would finance 97% of that purchase price, or $436,500. And then we put an average interest rate in here of 6.75. The term of my loan, which would be a 30-year fixed product. Assumption that I would buy a home, say, in October of this year. Now, when I buy a home, and we'll learn more about this later on, but when I put less than 20% down, I'm going to have a thing called mortgage insurance. And mortgage insurance varies based upon my credit score, my down payment, how much I finance. But we put a factor here for a 3% down scenario. Homeowners insurance, which also varies where in the country I'm going to buy. If I'm in a fire zone, or maybe I'm in a high windstorm area, whatever the case may be, homeowners insurance does vary. My tax rate also changes by where I'm going to buy. And maybe I'm going to think about buying a condominium or a townhouse. I might have HOA dues that are attached with that as well too. And then these are some of the important features also that we got to consider in home ownership. What's my tax bracket that I'm at? How much is it going to cost me to maintain my house? Because that's a new expense that I don't have today as a renter. How much is it going to cost me to sell my home? So maybe 10 years from now, I say, hey, I'm ready to go to the next home. I'm ready to upgrade a little bit. Well, how much is it going to cost me to do that at some point? So we kind of budget about 6% of the purchase price. And then we assume an annual appreciation rate of 3%. Now that will vary based upon where I'm going to buy in the country. And we'll talk more about market data in just a bit, but we're going to assume a 3% appreciation. So that's all kind of in our home ownership column. On the rental side of things, we're assuming a rent payment of $2,000 a month in rent. We have an assumption around renter's insurance, and then assuming that our landlord is going to increase our rent about 3% every year when I decide to renew my lease. So that's our comparison there. So someone that's going to buy a $450,000 home versus someone that's currently paying roughly about $2,000 a month in rent. So when I buy my home, I'm going to have to put an initial investment in, right? Investments like down payment and closing costs and prepaid items. And we'll talk more about this later, but essentially those are out-of-pocket expenses. Now, how is that going to translate to a break-even point for me? How long is it going to take me to be able to recoup those funds? Well, our calculator tells us that your break-even point, if you decide to buy at a $450 purchase price, would be about 4 years. So with those investments I make, I'm going to now be profitable, so to speak, in homeownership after 4 years, which is a really quick turnaround time. Generally, we want clients to break even in 4 years or less when it comes to home ownership. Now, if you're paying $3,000 a month in rent and you're going to go buy a $450,000 home, well, that calculation is going to be much more favorable for you. So now we know a break-even point is 4 years. So when I stretch beyond 4 years, now I'm kind of in the profit side of home ownership. And it starts getting a little bit more exciting for us as homeowners when we start spanning out further and further. So let's say after 10 years, now I have a gain opportunity of owning a home of $81,000 over that span of time. Now, not to mention I have a lot more equity in my home. I have $232,000 in equity. And so that is really kind of the magic of home ownership, being able to say, hey, I'm now owning something that's working for me. I'm creating tax deductibility benefits for myself. I'm creating appreciation in my home. And so that's an exercise I walk through with our clients during our consultation process that we go through with every client. And I would encourage you after class, if you have some time, take a look at that tool. I think it's a really eye-opening experience to really kind of figure out, like, where do I want to buy? And what do I think I want to buy? And how does that compare to where I'm at from a rent perspective? Well, as I think about my entry point to the housing market, one big kind of part of that entry point is going to be, what are the prices of homes, right? And so, that does change in different parts of the country. We didn't get a chance to poll our audience, but if you guys feel comfortable putting your location of where you want to buy into the chat, we'll kind of talk about some other markets. But the Virginia housing market is a bit of an upswing when it comes to purchase prices, and you can see that we're seeing median price push just over $450,000. The turn time in terms of the supply coming off the market is one of the lower ones in the country, believe it or not. There's some states out there that right now are over 60 days, median days on market. Some other states like Georgia, Texas, Florida, to name Colorado, to name a few, all have some of the highest level of supply right now in the market. So that's really a buyer's market there. You could probably argue that Virginia is still probably in like the seller's market space right now. And so, still a relatively affordable market in most parts of the state, but you can see an uptick in sales price. Those of you that dropped in the chat kind of where you're thinking about buying, appreciate that. That's super helpful because we're going to go over some market data as we go through tonight's class. And I did have a question come up about the tool that we just used. That is the rent versus buying calculator tool. It's in the slideshow, but Ken also dropped it in the chat too, so you guys can see the link there. So yeah, it looks like our class is kind of all over the country. So yeah, we have Colorado represented, Massachusetts, Washington State represented. So, those markets, I would say, we just talked a little bit about Colorado. I think Colorado is a great opportunity for first-time buyers to get in that market because there's a little bit more supply out there. Washington looking very similar to what we see with California. Still really hyper-competitive market. And, we're seeing prices in both the Washington market, California market, kind of like this. It's not really this super massive increase. I think some markets, especially the high cost of living markets, have kind of maybe tapped out a little bit in terms of how much higher they can go in price, believe it or not, because we're just not seeing wages supporting some of these higher levels of prices. A good example of that would be the Bay Area in California. We're just not seeing certain wages support cost of living. And so, especially as we're looking at entry points for first-time buyers, some markets, an entry point is $1 million to get into a home or even a condominium. So, we are looking at the forecast for 26, and it's changed a little bit because there's a few things going on in the world these days, but nationally, our forecast was this year to be a bit of a reset with home buying being a little bit more affordable in some markets. We did expect interest rates to go lower this year, but then, of course, we've had some changes with the conflict in the Middle East. It's kind of pushed interest rates up where we now see an average interest rate around 6.6 to 6.75, depending on the day in the market. So there's a bit of a kind of a cloud over the markets right now of what we kind of originally projected. So we're going to have to probably push out rates going much lower into probably 2027 and beyond into 2028. We're expecting price growth to be modest. So we're not expecting any big sales price jumps. And that's kind of to my point earlier about some of those high cost of living markets. And so we might even see some markets start to slip a little bit in price. So some markets that have more inventory, you're starting to see a little bit of softening in price. Right now, in our current active client base that we're working with all across the country, about 40% of all of the transactions right now have some type of seller concession, meaning either a reduction in price or the seller's conceding credits towards closing costs. And that's kind of a reflection, if you will, of kind of what some of those markets might be looking like. So we're seeing sellers being a little bit more flexible with buyers. We're looking at inventory improving slightly in some local markets, which can give buyers that are financially ready some little bit of leverage. And everybody's waiting for interest rates to go lower, and everybody wants the perfect storm. It's really hard to predict that. Just ask those that bought during the pandemic years. Yes, the interest rates were so much lower, but also the amount of competitiveness that we saw in the marketplace was just unprecedented. 2026 could be an awesome year for you to get access to homeownership. If you're financially in a good position, it could be a great time. But we understand the timeline for all of our attendees for class looks a little bit different. So this could be a goal for next year, could be for 2028, whatever the case may be. These tools will hopefully help you kind of understand that and where you're at from a financial perspective. Well, we talked a little bit about interest rates, and interest rates have been very volatile over the last 2 to 3 months, really. This is a snapshot of the 30-year and the 15-year fixed rate over the last 12 months. And you can see kind of just this roller coaster ride that we've been on. Interest rates have kind of softened up a little bit today, not a lot, but we had one of our inflation indicators come back a little bit, well, not lower, but in line with expectations. So the market was supportive of that. Beyond the conflict in the Middle East driving the interest rate and the overall financial markets right now, with the price of oil kind of all over the board, we're also looking at what's the inflation numbers look like, how much we're spending, right, as consumers. That was measured today to be in line with expectations. But we're also looking at employment numbers. Are new jobs being created? Are we seeing reduction in payrolls? What's happening right now? And so, the softer labor markets are, the lower inflation goes, interest rates will then fall lower. So we are kind of in just a little bit of a bumpy situation with interest rates. But we're obviously managing that for our clients that are, in the process of home buying, because it's our job to help them kind of navigate these markets to better understand kind of where interest rates are at. And but interest rates, so as a consumer, change by the minute. So when the financial markets open up at 9 o'clock Eastern Standard Time, they close at 5 o'clock Eastern Standard Time. Those interest rates can change by the minute. So we had interest rates a little bit better this morning when markets opened. By the end of the day, we actually went to a neutral position. So interest rates became unmoved. So that's important to know. But we will continue to see a little bit of bumpiness in interest rates. Now, interest rates aren't the same for all of our clients because it changes. It changes with credit score and eligibility for products. What type of program I'm going to select will have a certain attached interest rate to it, how much I'm putting down for down payment. Am I going to put money out of pocket and try to bring down my interest rate? We call that buying points. So usually when you buy a point, it's the equivalent of 1% of my loan amount, and it will drop your interest rate about 0.25%. All right. Now, the shorter term you do for a mortgage, that will also help you lower your interest rate as well. So if I go from, let's say, a 30-year standard conventional mortgage to maybe a 15-year mortgage, I might see upwards of 0.5% drop in overall interest rate. As I get a chance to meet with our clients and design their home buying plan and their journey towards homeownership, we're going to figure out what the right interest rate looks like and overall really loan structure for you. And so we'll do some of those kind of projections in our consultation sessions. Now, as we think more about interest rates, it's really easy to find interest rates online. In fact, while you're in class right now, if you want to Google what's the lowest interest rate, I'm pretty sure you're going to get a bunch of different searches coming back, right? Because the interest rates, especially as you see online, how they show up, it's important to understand as a consumer that there's more that goes on behind the scenes than just simply how an interest rate shows up. As I shared with you earlier, the average interest rate is about 6.6% today, but I'm pretty sure if you did that search right now, you would probably find a lender that would give you a 6% interest rate today. And the reason why that is because behind the scenes, there are cost structures involved with interest rate. I kind of alluded to it earlier, called points. And a calculation that shows up on disclosures for all borrowers is called APR. It's the annual percentage rate, which encompasses lender fees, point buy downs if you're going to bring down that interest rate, some of the general fees that a lender charges, everything that's associated with your financing. And it's shown up as a percentage in the first 12 months of your loan. And so why that's important is, so when I'm comparing a lender, for example, let's say I have a lender that says, hey, Jason, I'm going to give you a 6.5% rate. Great. Well, how much is that going to cost me? But then you have lender B that's saying, I'm going to give you a 6% rate. And you're like, well, wait a second, that's great. That's 0.5% lower. But what APR is going to drive is these fees that we see here. Because as you can see, APR for lender A, yeah, they're 0.5% higher, but they're also charging over $6,000 or almost $6,000 less in fees to get to that interest rate level. So that's important. Whoops, I'm going to jump back a little bit. So that's important. So when we're kind of doing our discovery of what options work for me, and this is something we go through in our consultations, we're going to better understand, like, what are the costs associated with that interest rate. So when we quote a client, we always quote them with no points, because frankly, in today's market, it doesn't make a lot of sense to buy points because it generally takes clients about 4 years to break even on those investments. So takeaway on this slide would be essentially, if you see a big gap between APR and interest rate, then we got to dig a little bit deeper, because then we have a lending situation where they're charging a significant amount of money in order to achieve that level of interest rate. Now, credit plays a role in our interest rate. So if I'm a 720 versus, let's say, a 760 credit score, that could change what the dynamic of my interest rate looks like. And so every loan program has a minimum credit score, and we've kind of showcased some of those minimum credit scores here. So as we go through the credit segment of tonight's class is to kind of identify some areas of opportunity in our own personal credit score, but maybe help us understand a little bit how credit score is made up. Now, there's actually 3 different credit models to credit scoring. There's credit card, there's auto financing, and there's home financing through the mortgage model. And of course, when you're applying for a mortgage, we're going to use that mortgage financing there now. And I think you guys are all aware of this. There's also 3 credit agencies that adopt that model. That's Experian, Equifax, and TransUnion. In lending, we always take the middle credit score of all 3 bureaus. So if my highest score is 760, my lowest score is 740, my middle score is 740, and my lowest score is 720, well, then from a qualifying perspective, we're going to use the 740 credit score to determine the right product, interest rate, even the cost of mortgage insurance. If I'm going to have a partner that's going to join me and their middle score is 710, that could impact my interest rate offering, product, and of course, mortgage insurance. So we want to be very strategic in how we build financing for clients, because that credit score makes a difference. And hopefully we can identify areas of opportunity to help lift that credit score. If I've had past challenges on my credit report, especially in the most recent 12 to 24 months, that's going to be more impactful on my credit score than something that happened 4 or 5 years ago. This matrix here shows you if you've had a past late payment or a hard inquiry, how long is it going to stay with me on my credit file? Now, it's going to impact you in the most recent 12 to 24 months, but how long that kind of legacy will stay with you on your credit file is shown on this matrix. Now, we really want to avoid hard credit inquiries, because hard credit inquiries can negatively impact our score, especially in the most recent 6 to 12 months. There are rules in place for both auto financing and mortgage financing that says that when I start my discovery work and working with an auto lender or a mortgage lender, I have a 30-day window of time to shop around with as many lenders as I want. And it's the equivalent of 1 credit inquiry hit to my score. Now, our approach is a little bit different as we work with you, because we actually do a soft credit in check when we work with our clients. We don't actually do a hard inquiry until you're under contract with the seller. The reason why we do that is because we want to guide you in home financing options, but not put you on kind of a time clock, so to speak, to buy. So we can look at your credit, design the right product for you, help get you qualified for your financing, and not have to worry about your score being impacted. Now, as we look at the score calculation, this is a mortgage score calculation, so you can get a sense of like, what are we looking at in that score model? I would hope that as you guys hear me kind of speak to these different areas, maybe it'll kind of like resonate a little bit, but more importantly, like give you kind of a thought that, hey, these are some things I could personally work on my own credit score. Now, the first area is really difficult to work on. It's just length of credit. So how long have I had my credit file open? So that's going to just be more of a time type of thing. So the more mature my credit file goes, the better my score is going to improve. Now, what we can control is how much credit am I trying to get access to? So I want to avoid really opening a lot of new accounts, maybe 2, 3, or 4 in the most recent 6 to 12 months. I just spoke to the hard inquiries. You also want to avoid that, because that's 20% of the score weighting. And then down here, this is one of probably our biggest areas of opportunity for most clients I partner with, is that identifying and paying down credit cards that are a higher utilization of credit. So our balance to credit limit ratio. So if we're saying, we're at 80% ratio right now, or utilization, that means our balances are, let's say, $8,000 on a $10,000 credit limit. That means I'm at 80% utilization. Our first step, if we had a client in that scenario, would be to say, hey, let's try to do our best to push that balance from 80% utilization to 50% utilization. Once we've kind of gotten that level, then we go to 30% utilization. That starts getting an even better improvement in credit score. And then we go down to 10% or less. 10% or less is the optimal level to keep your credit cards at. Now, there's a billing statement date in the credit card accounts, which is a 30-day cycle date of activity. My tip for you in class, if you're trying to really push down your utilization and maximize credit score, try to pay down your credit cards before the end of that statement date, because if you do that, then you get ahead of the reporting that goes out to the agencies, which will allow you to get lower utilization, lifted credit score, and of course, just give you an overall better profile for when you're getting ready to qualify for something. And then the last section is just payment history. Essentially, how have I paid my bills? So I want to obviously maintain on-time pay history. If I've had some past challenges, you saw our matrix about how long they'll stay with you on your credit file report. It's again in the most recent 12 to 24 months where you see the impact. And late payments are rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. One of the accounts that will show up on credit reports is student loans. And so many of our clients that attend classes just like this have student loans in some capacity. So I want to give you just a quick high-level look at how we view student loans. If you're in an active repayment program with student loans, let's say it's a $250 payment on $75,000 worth of debt, that payment can be used right away for qualifying purposes. Where it gets a little bit more challenging, so to speak, is that if you're not in active repayment, you're in forbearance or in your deferment, because then by the guidelines of financing, we have to apply a minimum payment. So it's usually 1% of the balances that we would use on a conventional loan, 0.5% for an FHA loan. And I know many student loans, especially some of the federal servicers, are starting to come back online with payments. But we will walk you through how we calculate your student loans as part of a consultation. The reason why we kind of go through those guidelines, or part of the guidelines, I should say, are because every loan program that you see on screen here has a different view on student loans or any other characteristics in financing. So I want to take you through a look at some of the different programs that are available to you as first-time homebuyers and give you a little bit more context around each one of those product lines. So the first one is a conventional loan, which is basically a Fannie Mae and Freddie Mac type loan. For a first-time buyer, it's a minimum down payment of 3%. You can see our minimum credit score on screen, and then it goes up to a maximum loan amount of $832,750. Now that's called the conforming loan limit, which adjusts about every September or October. So we'll probably get some guidance on that in the next 30 to 60 days. If you're in a high cost of living, so you're trying to buy in Alexandria, Virginia, that is called a high balance area. And so you could actually go up to a higher loan amount, up to $1.2 million. But the difference is we have to move from a down payment of 3% to 5% in order to participate at those higher loan amounts. So if I cross over that $832,750 threshold, then that down payment is going to lift as well. FHA is the next product. That's a Federal Housing Administration loan. That is a government insured loan. You can see our minimum down payment on that product. And the loan amount's a little bit different than a conventional loan because it will vary based upon the county that I'm going to buy in. And the FHA product's going to have a lot more flexibility to qualify than what we'd see maybe in the conventional product. Both the FHA loan and USDA loans are both government insured loans, and they do have, unfortunately, some residency requirements. You do have to be a permanent resident for both of these products, whereas on the conventional loan, you do not have to be a permanent resident. You can be a non-permanent resident and still get access to a Fannie Mae product. The USDA product's a little bit different, even though it is a government insured product. It focuses on more rural areas. And the benefit around that is you can get 100% financing, but it has to meet the eligibility for the location, and you have to fall within a household income limit. The jumbo loan is not going to be, for most of our clients are going to be purchasing in that space, but it has higher down payment requirements, higher credit score requirements. It's really for probably more of our second and third time buyers, but at times we have first time buyers that need a little bit more kind of purchasing power that stretches beyond the capabilities of maybe say the Fannie Mae and Freddie Mac product line. And then finally, there's the VA home loan. That's for our veterans that have eligibility. It's a zero down payment option, lower minimum credit scores, a lot more flexibility for our veterans to get access to home ownership. For those of our veterans that have any partial disability, there is a exemption for the funding fee that's typically charged on the VA product. So the VA product's a great access to home ownership for our veterans that have eligibility. All right, so that's kind of a look at some of the high level of programs. I don't have on screen here, but I'll just kind of share with our audience. We do offer a physician's loan program as well too that has a different kind of guideline, if you will, when it comes to student loans, because let's face it, when we get out of medical school, we're going to have probably a little bit more debt. The physician's loan can actually have more of a relaxed underwriting guideline to that. Those are the options that we have available within APM as well too. So if you're interested in those programs, certainly that's something we could take a look at. That's eligible for chiropractors, dentists, active practicing physicians. So if you have interest there, please feel free to message me on that. Let's talk a little bit about PMI, which is private mortgage insurance. And I want to give you a look at PMI, which coincides with conventional loans, and then MIP, which is mortgage insurance premium that has to do with FHA loans. So on the conventional loan side, the PMI, I should say, is calculated based upon credit score, down payment, and how much you finance. Well, PMI, so you understand what it does, it essentially protects the lender against a default by the buyer. So if the buyer had a economic hardship and was unable to make their payments, that's where the PMI would step in to protect the lender. Now, one of the benefits with PMI on a conventional loan, it does have a cancellation option. So once I reach 2 years of my loan and I have 20 to 22% equity, I can apply to have that mortgage insurance canceled. So that's one of the big benefits with conventional. And it is tiered in terms of the pricing of PMI. Here's an example of what a PMI calculation might look like. If you guys have started doing some searches and use some calculators on some of the more popular search sites like Zillow or Redfin, we found those sites to have a little bit more of an inflated PMI level. You can use our calculators on our website. We found those to be pretty accurate, but that gives you kind of an example of someone buying a $450,000 loan amount, what that might look like. On the other side is FHA. And so there's a little bit of a trade-off with FHA because with MIP, there's two forms of mortgage insurance. There's upfront mortgage insurance. There's also monthly mortgage insurance, and it's all fixed premium, so it doesn't change based upon my credit score. So we have upfront mortgage insurance, which is 1.75% of my loan amount, and then we have 0.55% for the monthly amount. So we have the upfront and monthly. The difference with FHA is it's not canceled once we reach that equity threshold. Only way we can cancel FHA is that FHA mortgage insurance is if we refinance into more of a conventional product. So it is going to be a little bit more expensive than the conventional product. And you can see our calculations down here. There's the upfront mortgage insurance and the monthly MIP. So FHA, at times I've found some lenders will use that as a default for buyers that are putting less than 20% or 15 or 10% down because they don't realize that a buyer can contribute 3% on a conventional loan. So if we qualify for a conventional loan, we certainly want to go the 3% first-time buyer route through Fannie Mae and Freddie Mac. It's going to be a lesser expensive option for you for sure. And the question I get often, and in fact, I just got this earlier today from a client in Southern California was, Jason, I want to go FHA because the interest rate is so much lower than a conventional loan. And they absolutely are right. I mean, usually FHA loans are going to be about 50.5% better than the conventional product. But here's the trade-off, and you guys have kind of seen it. The upfront mortgage insurance, the cost of, that interest rate variance and the monthly mortgage insurance is dramatically different. So interest rate is only part of the equation. We have to look at all of the other components that go in that makes up our overall kind of housing budget. So just be aware of that, especially when you're doing online searches, you're seeing, some artificially lower rates than market. It's probably going to be an FHA loan, or to my point earlier, it could be a rate situation that is showing a significant amount of points to buy that interest rate. All right, now we're going to pivot from looking at product and now talk a little bit about employment scenarios when it comes to home ownership. So I get a lot of questions on various income scenarios or calculations. So I want to first share with you some of the various documents that we're going to ask for as part of the process. So as you're deciding to take the next steps in home ownership, these are some of the items that we're going to ask for in the general documentation. And then, and that can be also uploaded to your profile securely as you decide to take those next steps. But let's go through some employment scenarios that I think you'll probably find pretty helpful, which basically centers around like, how long do I have to be on the job? So in financing, we only have to show a 2-year history, but that 2-year history can be inclusive of what we have for education as well as our on the job experience, right? So let's say I just started my job this spring, right? I graduated in the fall, started my new job this spring, but I went to UVA, was there 4 years. I can tie in that 4-year education with UVA on top of the time I had my job, so I can meet that 2-year requirement. So if I have a base salary that it's on my job, I'm making $70,000 a year, that base salary can be used right away for qualifying purposes. So you don't have to wait beyond the job 2 years to be able to use your income for qualifying. So we're just have to verify that 2-year education and employment history. Now, if you're in a job or a role that has variable compensation components, like let's say overtime or bonus, those are sources that have to have more of a historical average done on those. So generally we have to show that I've been doing that job with those pay structures for at least 2 years. So that's where the 2-year rule is a little bit more important. If I'm in an hourly role and I get an hourly of $28 an hour and I make overtime of an additional bump in pay and I'm working 2 hours a day in overtime, that can be calculated into our income factors, but we do have to show a 2-year on the job in that scenario. Another way or which the 2-year rule is in place is that if I'm self-employed, so like if I have a new business I just opened and I want to, be able to use my income for qualifying in business for self, we always look at the net income basically, and we have to show that someone's had that business and been actively filing taxes for 2 years. Another scenario that comes up, especially for our clients in the tech industry, if you're working for a startup or maybe working for our bigger tech firms like a Google or Amazon or whatever the case may be, if you're in that role and maybe you're getting restricted stock grants to you, you can translate those restricted stock grants into income for qualifying. But we have to show you've been with your employer for at least 2 to 3 years. And then we take an average of the stock value and we can use those vested shares as a calculation towards income. So, and then last thing I just want to point out too, we do have some clients that have maybe side income, whether they're driving for Uber or Lyft or whatever the case may be. If we want to show both a 40-hour work week job in addition to the side income, we have to be doing both things for 2 years. That would also be inclusive of like 2 part-time jobs. If I want to use both sources, then we have to show a 2-year on the job history. All right. Okay, we're moving along pretty good here. We're going to talk about debt to income ratio because it kind of ties in with income. And essentially what debt to income ratio is your today expenses, like maybe your credit cards, your auto payment, your student loans, everything that kind of shows up on your credit report. And then we add that into projected housing expenses, things like the principal and interest of your mortgage, property taxes, homeowners insurance, maybe mortgage insurance because you're putting less than 20% down. So we take all those expenses today, projected expenses, and then we look at that in comparison to your pre-tax income. And we call that debt to income ratio. And we put an illustration of a calculation up on screen here. So this is an example of someone that has $2,500 as their projected housing expense, $500 in current expenses, and they're making $8,500 in pre-tax income. So right now their debt to income ratio is 35.3%. So that would be well within the qualifying guidelines for any type of program. In fact, we can go up as high as 45 to 50% debt to income ratio in most scenarios. But that's just a metric to qualify clients. We really want to dig a little bit deeper into having the conversation around affordability. So even though we can qualify this high, doesn't mean we should buy way up here. Maybe our comfort zone is a little bit lower. Most of our clients that I partner with in their journey towards homeownership, they feel good when their debt to income ratio is like in the 33 to 36% range. I think that's kind of really more of the sweet spot, so to speak. But a lot of it has to do with where I'm buying, right? If you're going to buy in Santa Clara County, then that's probably going to look a little bit different than we're buying in DFW in Texas, right? So those dynamics of those two markets are going to look a little bit different because my $100,000 income in DFW is going to look a lot different than my $100,000 in, say, a Santa Clara County market. So I might have a different debt to income ratio. And we'll obviously coach you through that as we figure out your path towards homeownership. One of the last things we want to look at as we're thinking about, what makes up our plan for homeownership is how much do I have saved? What resources can I pull from that can help me enter homeownership? We're going to talk about assistance programs in just a bit, but we always have to verify the assets used in a home purchase, whether that's using cash accounts like checking and savings accounts. We can't use like unsourced cash. So everything has to be seasoned at least 60 days. You can also draw from retirement accounts, 401ks, 403bs. When you take out a 401k loan, for example, you're taking out a loan against your asset, but it also pulls that money out of the market so you don't get the appreciation in the asset. And then you repay that generally through your payroll with your employer, right? So we want to use that as kind of a plan B or C option in home ownership, but certainly you can tap into those resources. We would always ask you to talk to your tax or financial advisor before you decide to go down that path. Family members can also help out. That's where they're gifting funds in a transaction. There is no seasoning requirement. So, if you had your uncle that wanted to contribute $50,000 to buying your home today, as long as your uncle was able to fill out a gift letter, which we would provide, and we can track the asset, that could be used right away for the home purchase. Now, this is probably one of the biggest hurdles for most first-time buyers is, do I have enough money saved to buy my home? So we might be making really great money, but we're just not quite there from a resource perspective. So one of the things that I always coach clients through is a savings plan towards homeownership. It's a really simple mathematical equation, but it's looking at where am I at today? So in this example, we have someone paying $1,500 a month, but then getting a sense of like, what do I think I can pay for homeownership? So let's say that number is $1,500 for rent, and I think I can pay $3,000 in mortgage after going through our free consultation. Right now, we have a delta of $1,500. That means we have a surplus, so to speak, of $1,500. So I would coach our client to start saving like they're paying a $3,000 mortgage today, right? So every month I pay my landlord. I know I have a $1,500 surplus. I just transfer that right to my savings account every month in, month out. That $1,500 goes in there. By the end of 6 months, I have $9,000 built up in those reserves. End of 12 months, I have $18,000. And if I decide to be smart about that money, I put into a high yield account that's going to pay me I think maybe I saw 4% yields on interest. Then I'm having that money make money for me as well too. And before you know it, now you have start building out a nice little resource or reserve for your down payment. And it may take several months, but I think it's a great way of building up savings, but also creating the discipline, but also understanding like it's not going to be a big transition for me when I go from my $1,500 to rent. But now I'm in my house now and I'm making a $3,000 mortgage payment. It doesn't feel like such a big burden. All right. Well, I mentioned to you there's first-time buyer programs all across the country, and I know we have a lot of different states represented in tonight's class. Just so you guys know, every state has some type of housing finance agency, and they're categorized as different names, but ultimately they serve the low to moderate income population. And low income essentially means that if I'm making less than 80% median income, then I'm considered low income. Then you have 100% median income. And then some states like California will go up to 150% of median income. Most first-time buyer programs across the country will generally go up to that 120% median income. In Virginia, there's programs like the Virginia Housing Program that creates a lower cost structure for you as a first-time buyer. You can also get grants of 2 to 2.5% of your sales price and assistance. There's a Virginia Housing Plus Second program of anywhere between 3 to 5% in assistance. So there's ways that we can stack different products together to figure out like how do we lower the cash amount out of pocket for you so it can make homeownership just more of an attainable goal for you. So everybody's scenario is a little bit different, but part of our consultative process, we're going to figure out like where's your income at? How does it stack up in relation to the income limits for the respective assistance programs that you want to look at? So we'll discover that during our one-on-one. And then there's other programs that we offer both internally in APM, but externally as well too. But we have the Pathway program that provides anywhere between 3 to 5% in assistance of the sales price. Now, that is not an income limited program, so you can have access as long as you're a first-time buyer. We also have our APM 1% down program, which is a really cool product. It does serve the clients that are 80% or less of median income, but essentially means that if you contribute 1% of your own funds in say a $300,000 purchase, then we will match you in the form of a grant of another 2%. Up to $4,550 that we would contribute. So that's a great product. We've had several clients across the country be able to participate in that. So hopefully you have some encouragement from hearing about down payment assistance, because I think, when I first talk to clients or before they've come to classes, they're like, hey, I think I got to put 20% down to buy a house. Hopefully we've dispelled some of the myths around that you can actually access homeownership with not only a low amount of out of pocket, but also be able to get resources that can help pour into what you need to put out of pocket to buy a home. Now, if you're in a position where you can put 20% down, great. Then, we have lots of different options, but most first-time buyers that attend a class like this are not in that financial position. Now we're going to talk really quickly about closing costs because I get a lot of questions around that, and then we're going to just transition into the workflow of owning a home, and then we'll get you out of class. So we got a little bit more time left. Let's talk a little bit about closing costs, and that kind of is part of the component of savings. So what are closing costs? Well, closing costs are what a lender is going to charge you, what third-party title vendors are going to charge you. Maybe you're in a state that has attorneys' offices or escrow companies. They're going to be part of it. County charges, transfer taxes, and stuff like that. They all make up closing costs, but there's also what we call prepaid items when you buy a house. Things like prorated taxes, insurance premium for the first year. So we have to bake that into our budget when it comes to buying a home. Closing costs can really vary based upon where you're going to buy, what you're going to buy, and who you're going to buy it from, because there are negotiations that happen with a seller. It's pretty safe to say that I would probably budget about 2 to 3% of your sales price for those closing costs. But that doesn't include the prepaid items. Those are usually a little bit of an add-on because the prepaid items will vary based upon what you're going to buy and what time of the year really you're going to buy. So if I buy later in the year, my prorated taxes might be slightly lower than say if I bought in April, but it ultimately kind of depends on what what state you're going to buy in. When we do a pre-approval with a client, we're going to provide you with an estimate. So that pre-approval is the output of a one-on-one consultation. So we're going to break down closing costs for you, and you'll understand kind of what that looks like. One of the benefits you get as a UVA alum, we actually discount those services for you by $750. So we have a lower closing cost structure and try to put the most competitive product in front of you for your options in homeownership. Now, once you're under contract to buy a house, so let's say you have an agreement with the seller, you've come to terms, then that's when you have now finalized who's paying for what in terms of the home purchase and how much it's going to cost you. And we review that in detail with you as part of one of our steps in the process called the follow-up video session. Now, when you're thinking about buying a home, what are ways that you think you can lower those costs? Well, one would be is let's try to negotiate with the seller for them to take on more closing costs. That would be part of like kind of how we negotiate the contract, especially when we get in states that have higher inventory levels where the buyers have a little bit more of an edge. That's where you can start getting into conversations around seller credits, where the seller says, hey, Jason, I'm going to credit you $5,000 towards your closing costs to help lower that expense for you in your transaction, right? And so sometimes that negotiation happens up front with the seller just before you make an offer or get the offer accepted, or it happens while you're in what we call the escrow process, where you're going in and saying, hey, we got our inspection reports back. All this stuff needs to be fixed, but in lieu of fixing that stuff, I would like a credit of $5,000 or whatever the number is. Okay. Now, also loan programs like we just viewed through first-time buyer programs can provide assistance that can help offset what you would have to put out of pocket as well. All right. I know I've been kind of going and moving along here, but if you guys have questions on any of the topics I'm covering, just drop those in the chat and then I'll take a look at those. And we'll have a little bit of time left over before class to be able to go through any questions that come up. Let's talk a little bit about the buying process and where do we go here from tonight's class. Well, hopefully you have a few takeaways that have kind of got you thinking a little bit about home ownership, and maybe it's more of a closer goal than you expected. Well, our next step would hopefully be to get connected with you for that free consultation where I get a chance to meet with you for a 30-minute session and help just design your path towards home ownership. And it's not something where you're expected to go out and buy a house this weekend. It's just kind of putting the framework together for you for home buying. Some clients are ready to go right now, and that's great, but it could be a 1 or 2 year process, and we understand that. But ultimately, a consultation gives you the goals and objectives to get to your goal of home ownership. The output of that session is to get you pre-approved, so you know kind of where your baseline is for qualifying. And then we ultimately will kind of tailor things based upon what it looks like as you kind of proceed in your progress towards starting to go out and start house hunting. Well, whenever you're ready to go out and start looking for homes, that moves you to the next milestone in this 6-step process, which is the house hunting phase. And that's when you're probably starting to do some online searching. You're looking at, hey, what communities do I want to buy in? What's the school district I want to maybe land in? What's the lifestyle I want to have in a community? What type of property? Is it a condo, townhouse? Well, I start identifying that. And then when I start kind of like zeroing in, I probably want to start having conversations with a realtor. And a realtor should be an expert in their market and know all of the facts that you need to make a good financial decision. And we partner with that realtor during the process. We also have preferred realtors that we work with as you go through this journey that we can recommend to you as well. Now, step 2 is probably the longest phase of the process. So house hunting can take the longest. It can be 2 weeks for some clients. Sometimes it's 2 months. Sometimes it's 2 years. So it really just depends on where you're at and kind of what you want to buy. And maybe you want to be in a specific neighborhood, right? And there's only so many homes that come on the market. So it really just depends. But ultimately, at some point, you'll probably find the home that works for you. And then your realtor will work with you to submit an offer to the seller. And if that offer gets accepted, now we start kind of moving into more of the lending process of things. And that takes us into step 3, which is called entering escrow. And it's categorized as different things in different parts of the country. But what it basically means is you and the seller have come to terms on an agreement to purchase that home. The day that happens, in fact, after this class, I got to call a few of our buyers in different parts of the country to say, hey, congratulations, because I'll call you that day and say, congratulations, your offer's been accepted. Let's schedule your follow-up virtual session so we can go through all the details of your home purchase, what the costs look like, the prepaid items that we reviewed earlier today, and then kind of just figure out like how do we want to build your financing as we put the finishing touches on everything. So that happens usually in about 24 to 48 hours that we do that video session with you. Now you will have action items as a buyer once you get into step 3, like you have to make a deposit on your house. You're probably going to want to work with your realtor on inspections to get set up. In most parts of the country, there's a thing called contingencies that will protect that deposit. But that deposit is usually 1% to 2% of your purchase price, and it will count towards your total out-of-pocket expense. So here's what contingencies are. They basically give those protections of the deposit that you're going to be allowed to do some like research on this property before you get too far along. And it includes getting the house appraised. We want to make sure the house is worth what you're buying it for. Get your inspections done on the house. Make sure there's nothing that's lingering that we don't know about. And then, of course, get your loan approved. And in most parts of the country, it happens in the first as short as 7 days of the contract period to as long as like 30 days. I would say probably the sweet spot is probably 14 to 17 days as most contingency periods, but it's a protection for you as a consumer while you're going through these different milestones. Now, step 4 would take us to more of the administrative stuff, verifying your employment, verifying assets, making sure our product is all set up. That's going to be after our follow-up video session that happens just after we've gone under contract with a seller. Now, remember my conversation earlier about interest rates. Now, keep in mind, interest rates change by the minute. So once we're under contract, we're really going to start talking strategically about timing the market for interest rates, because interest rates could be 6.75 one day, it could be 6.6 the next day, but really want to be strategic and keep you aware of what's happening in the market. So that takes us through step 4. Step 5 is going to be like the underwriting side of the process, where we're going to kind of like make sure that everything qualifies for a client. And then after that, we get done with that approval, then we issue a final closing disclosure to our clients. There's different disclosures that go out throughout each milestone of the process, but really the final closing disclosure kind of trues up all the numbers in the process and gives you a 3-day cooling off period as a consumer before we get to the very final milestone called closing the loan. Now, typically from contract to getting the keys, which is going to be at step 6, it generally takes about 30 days in most markets. But there's other markets that are a little bit more competitive, and then a buyer has to kind of streamline the process, and we can close as fast as 14 days in markets. But I would say probably on average, it's about 30 days for most of the states that I see represented in our class today. So that's where I would expect that to look like. Now, the very final milestone is step 6, and that's when you're going to be signing final loan documents in person with a notary. All the documents that are transmitted from the lending side for our organization will all be electronic. But on the closing day, you'll be signing final loan documents with a public notary. You'll wire in your final funds for closing. That will kind of tie everything together, including your loan funds. The escrow company or title officer or maybe an attorney's office will then record documents with the local county recorder's office once everything's been all kind of settled up. They'll record a transfer of ownership called a grant deed, and then a deed for the mortgage, which basically is like the repayment terms of your loan. And guess what? Once all that stuff gets recorded, finalized with the county, that's when that's all done. That's when you now are the homeowner of that home, and a huge day of accomplishment, huge day of celebration for us to be able to take you to the finish line. But our relationship doesn't stop there with our clients. You know, we have a very streamlined aftercare product program, I should say, which basically we want to stay connected with you after the buying of your home, whether that's just keeping you up to date with our rate watch system on the market and opportunities to refinance, whether that's just helping you track your home equity and seeing how that equity is growing through our HomeBot system, and just checking in with you on an annual basis just to see how you're doing and how homeownership is working for you, but always being a connection point for you even after the finalization of your home purchase. So that's what the home buying process looks like. If you're thinking about moving forward in the process, we would just obviously love to partner with you on that journey. This is our simple 3-step process. Includes an online application with only a soft credit check. Then you would upload some documents and then use our scheduling system here to schedule your free consultation. So it's a 30-minute virtual session that I would do with you just to figure out what does homeownership look like for you. So the only expectation in that session is to be able to impart some information for you that you can really have a customized plan for you in homeownership. You know, whether that's a now purchase or a future purchase, at least you kind of know what things look like. And these are kind of the talking points in that conversation that we're going to have. Many of the things that we just went through in our discussion today in class. We really try to lean into technology so you can apply through mobile, but we also use some different AI tools to better support our clients. I always share with clients, so it doesn't replace the human side of our business. You know, AI is obviously changed a little bit of how we do business in terms of how we use different technology to maybe build financing or whatever, but it doesn't change our relationship with our clients, because ultimately this is the largest purchase you're going to make. And so we really try to make it a high touch experience, whether that's just being there for a simple call or a text or whatever, just to make sure you have reassurance and support as you're going through this journey. Because we understand this is a big undertaking for many of our clients that are taking those next steps in homeownership. So with that said, this kind of takes me to the end of class. I wanted to again spotlight, we have our discount program available for our UVA alum. You have obviously access to these classes. We'll have all the recorded version, all the slides up. If you like the content that we shared with you in our classroom, love to have you share that with friends and family. They're more than welcome to attend any of our upcoming future classes. We have still quite a few classes that are going to be going on for 2026. Here's all my contact information, so feel free to reach out to me in one of those ways. And then, of course, we try to put some great stuff on our socials, so feel free to check out not only just the content we're putting out there, but really what some of our clients are saying about us. That kind of really means a lot to us, all the experiences and the testimonies that we get from our clients. So that brings us to the end of class. We have about 5 minutes left, and I just want to make sure that if there's any questions from our class, love to be able to take those on for you. And I know we're right now on the East Coast, right now about to 7 o'clock. So thank you so much for spending time with us during your dinner. And I know in the Central Time Zone, we're kind of just getting in the door, and Pacific Time, we're still kind of at work. So appreciate you guys spending some time with us. So you're absolutely welcome. Yeah, so the free consultation that I mentioned, somebody put that in the chat, was that's where we just meet for a one-on-one 30-minute session. So we just go through, you would submit an online application, we'll do like the soft credit check, you'll upload documents, and then we just meet for a 30-minute session. That's what I spend a lot of my time doing throughout the day, as well as teaching classes like this, is just working with clients on their home ownership goals. So yeah, and that's just something where it just kind of provides some value to you, so you can understand like directionally what are you doing with home ownership. Right. Another question came in was, does the amount you put down impact how competitive your offer is to the seller? It can be, depending on the market. I think, if you're looking at, minimum 3% down versus say a 20% down payment, that could look a little bit different in the eyes of the seller. I think communication is really important to the selling agent. When I work with clients in all different markets, we're generally copied on the offer that goes to the seller. And then I try to reach out to the listing agent to say, hey, this is who we are. This is who our clients are well qualified. Because at the end of the day, whether you're putting 3% down or 20% down, if you're a really well qualified client and you have the right financing, like, we will get to the finish line. But I think it's just giving some more kind of context to the seller about what your financing looks like. Are offers made with 3% down, FHA loans, et cetera, competitive, or is it hard to compete with all cash offers? So 3% down would be a conventional loan, and then 3.5% would be FHA. So, cash offers are still out there. They're not in circulation as much now, but keep in mind, when somebody's offering cash for a house, they're usually trying to ask for a discount on the price of the home. So I wouldn't get that to sway us from making an offer on a house. In fact, we just had one in one of our markets here the other day where the client was making an offer against a cash offer, but the cash offer wanted a $15,000 discount on the home. My client was putting 20% down, but still. So cash offers, while they might seem easy, generally the seller's going to have to make some concessions. So I think you can still remain competitive. If you're able to put 20% down, is there any situation where it would still be better to put less down? It just depends. We just have to do the analysis. If you have a higher credit score and you're going to put 15% down versus 20% down, honestly, the mortgage insurance is going to be very minimal, especially if you're, depending on what your purchase price is. But yeah, if you're at a 780 credit score and you're putting 15% down versus 20% down, and let's say you're buying a $500,000 home, you're probably looking at mortgage insurance that's around $30 to $40 a month. So, think about it. If I have to go from 15% to 20% down, that's $25,000 more I got to come up with. So maybe it makes more sense for me to do mortgage insurance. So the question was, I'm not sure about location yet. I'm assuming that it would be best to know the location first to start the process. I'm looking to buy within the next few years. So you don't have to have a location identified yet. It's helpful because definitely prices change. If I'm looking to buy in Atlanta, Georgia versus Dallas, Fort Worth, and that could look a little bit different. But I would say just having a general idea. Again, the consultation goal is to just provide some goals and objectives and understanding about homeownership. You may say today I qualify for a $400,000 house and that feels really good for me, but you may get this big promotion 2 years from now, and now I'm looking at $500,000 homes. So, okay, you're welcome. All right. Any other questions? Okay. All right. Well, I missed my time down in Charlottesville. We get to get down there and see everyone on campus. We had a good time. I was out there a couple years ago, had a great time. So we'll have to get back on campus again. But it's always good to see everybody in a virtual environment. And please reach out to me if anything I can do for you guys. Look forward to hopefully getting a chance to connect with you. I wish you all a great rest of the week, and hopefully I'll see y'all soon. Good night.